Alright, let's get right into it. When you first look at a stock chart, it can seem like a totally random and chaotic mess of jagged lines going up and down. It looks like there's no rhyme or reason to it, and that making money from it is just pure luck. But what if I told you that hidden within those charts is a secret language, a language that, once you learn to read it, can tell you a story about where the price might go next? This isn't about some magic crystal ball or a get-rich-quick scheme, it's about understanding market psychology, and the two most important words in that language are support resistance. These concepts are the absolute foundation of what's called technical analysis, which is just a fancy way of saying using charts to make smarter decisions. Think of the market as a giant auction house where millions of people are constantly buying and selling. At any given moment, there's a battle raging: buyers who want the price to go up, sellers who want the price to go down. Support and resistance levels are simply the battlegrounds where these fights are most intense. They are price points on a chart where the momentum has historically shifted. By learning to identify these key areas, you're not just looking at squiggly lines anymore. Instead, you're seeing a map of potential opportunities and risks, giving you a massive edge over someone who is just guessing or trading based on a gut feeling or some hot tip they heard on the internet. Let's start with the absolute basics and define these two terms. First up is support. I want you to think of support as a price floor. It's a price level where a downtrend is expected to pause or reverse because of a concentration of demand or buying interest. Imagine a stock is falling. As it gets cheaper and cheaper, it reaches a point where buyers suddenly think, wow, this is a great deal. They start jumping in and buying up the stock, and all of this new buying pressure is enough to stop the price from falling any further. That price level, where the buyers stepped in to support the price and prevent it from dropping lower, becomes a support level. It's the point where demand is strong enough to overcome supply. On the flip side, we have resistance. If support is the floor, then resistance is the ceiling. It's a price level where an uptrend is expected to pause or reverse due to a concentration of selling interest. Let's say a stock has been going up and up, and everyone who bought it earlier is feeling pretty good about their profits. As it reaches a certain price, sellers start to think, this is getting a little expensive. Maybe it's a good time to sell and take my profits. At the same time, new buyers might hesitate, thinking the price is too high to get in now. This wave of selling pressure resists the price from going any higher, and that level becomes a resistance level. It's the point where supply is strong enough to overcome demand. The main difference between the two is simply the direction of the price trend they halt. Support stops prices from falling, and resistance stops prices from rising. They are two sides of the same coin, both representing a psychological barrier in the market. It's also super important to understand that support and resistance are not exact single price points. It's much more useful to think of them as zones or areas. So we know what these levels are, but why should you actually care? The answer is simple. They provide context. Without support and resistance, a price chart is just noise. It's like trying to navigate a city without a map. These levels act as your key landmarks, telling you where you are in the market landscape. They help you gauge whether a stock is currently cheap or expensive relative to its recent history. For a trader, this context is everything. It helps you make a critical decision. Should I be looking to buy? Should I be looking to sell? Or should I be doing nothing and just waiting for a better opportunity? These levels are also powerful because they are a self-fulfilling prophecy. Traders' investors' algorithms. When a stock approaches a well-known support level, millions of traders are thinking the same thing. This is a potential buying opportunity. So, they place buy orders around that level, which creates the very demand that causes the price to bounce. The same thing happens at resistance. The fact that everyone is watching makes these levels work, which in turn makes even more people watch them. It's a powerful feedback loop you can use to your advantage. Furthermore, support and resistance levels are your best friends when it comes to managing risk, which is arguably the most important part of trading. Seriously, your number one job as a trader is not to lose all your money. These levels give you logical places to set your stop-loss orders. A stop-loss is a preset order that automatically sells your position if the price drops to a certain level, limiting your potential loss. This framework turns trading from a gambling activity into a strategic business. It allows you to calculate your risk-to-reward ratio before you even enter a trade, ensuring you only take trades where the potential profit is significantly greater than the potential loss. Alright, let's get practical. How do you actually find these levels on a chart? It's easier than you think, I promise. The most basic and effective method is to simply look for price swing points. A swing point is a peak. A swing point is a valley. You'll want to open up a price chart. A candlestick chart works best, or a bar chart works best, and just look back in time. Look for the most obvious points where the price turned around. Where did the price stop going up and start coming down? That peak is a potential resistance level. Where did the price stop falling and start rising? That valley is a potential support level. The next step is to draw horizontal lines connecting these points. If you see that the price has bounced off a certain level multiple times in the past, that's a very strong clue. The more times a level has been tested and has held, meaning the price touched it and reversed, the more significant that level becomes. It's like tapping on a wall. If you tap it once and it holds, it's a wall. If you tap it 5 times and it still holds, you can be pretty confident that it's a strong, solid wall. So, look for at least 2 historical touch points or 3 historical touch points to validate a support or resistance level. You can literally use the drawing tools in your charting software to draw lines across these price zones. Another thing to keep in mind is the time frame you're looking at. Support and resistance levels on a daily chart, where each candlestick represents 1 day of trading, are going to be much more significant and stronger than levels on a 5-minute chart. Finally, remember that old resistance can become new support, and old support can become new resistance. To make this crystal clear, let's use a simple, relatable example. Imagine your favorite coffee shop sells a latte for $4. It goes to $4.50, then $5, then $5.50. At $6, almost everyone stops buying. People say, that's way too expensive for a latte, and they switch to making coffee at home. That $6 price point is your resistance level. The demand dries up, and the price can't go any higher because the sellers, the coffee shop, have no one to sell to at that price. They're forced to stop raising the price or even lower it to attract customers again. Now let's look at the other side. Imagine there's a huge surplus of coffee beans, and that same coffee shop starts running promotions. The price drops to $3.50, then $3, at $2.50, the place is suddenly packed. People who normally don't even drink coffee are lining up thinking, wow, $2.50 for a latte is an incredible bargain. All this new demand from bargain hunters stops the price from falling any further. That $2.50 price point is your support level. The buyers flooded the market and supported the price, preventing it from going down to $2. This is the exact same dynamic that happens with stocks, just with millions of participants. Let's apply this to a fictional stock. Let's call it TechCorp Inc. Over the past year, every time TechCorp's stock price has risen to around $150, a lot of investors have sold their shares, causing the price to fall back down. That $150 level is a clear resistance. Maybe early investors who bought it at $100 are happy to take their 50% profit. Maybe financial analysts have published reports saying the company is only worth $150 per share. Whatever the reason, the market has collectively decided, multiple times, that $150 is a sell zone. This makes it a predictable and significant level for traders to watch. So you've identified a strong support or resistance level. Now what? What actually happens when the price finally reaches that level? There are really only 2 possible outcomes. The price will either respect the level and reverse, or it will violate the level and break through it. The most common scenario is a reversal or a bounce. When the price comes down to a strong support level, the buying pressure that exists there is likely to overwhelm the selling pressure, causing the price to bounce back up, like a tennis ball hitting the floor. This is the market confirming that the support level is still valid. Similarly, when the price rises to a strong resistance level, the selling pressure is likely to be too strong for the buyers to overcome. The price will hit this ceiling and turn back down. These levels give traders high probability turning points. Buy at support, expecting a bounce. Sell at resistance, expecting a drop. It's important to wait for confirmation, like a bullish candlestick pattern forming at support, before jumping into a trade, as this increases your odds of success. The second outcome is a breakout or a breakdown. Breakout, price smashes through resistance and keeps going higher. Powerful signal, buyers overwhelm sellers. The old ceiling is gone, open space to run until next resistance. Breakouts often lead to fast, strong moves, can be very profitable. They signify that the bulls are firmly in control. Conversely, a breakdown occurs when the price falls through a support level. This is a very bearish signal, indicating that the sellers have taken full control from the buyers. The floor that was holding the price up has been shattered, and the price is now likely to fall much further until it finds the next area of support. A breakout above resistance, look for buying opportunities, while a breakdown below support, look for selling opportunities or simply stay out of the way. Now for the really good stuff, how to actually use this knowledge to make money. Let's talk about two basic effective trading strategies using support and resistance. Range trading, the bounce strategy, works best in a well-defined channel. Price bounces between a clear support level and a clear resistance level. Simple. Buy at support, sell at resistance. It's like playing ping pong with the price. Example, stock trading at $90, support, and $100, resistance. Enter a buy order near $90. Place your stop loss just below $90, maybe at $89. Profit target just below resistance, $99.50. You're risking $1 per share to potentially make $9.50 per share. Repeat, sell at resistance, buy back at support while the range holds. Great strategy for markets that aren't strongly trending. Breakout strategy, the second classic. Use it when you expect a level to fail. Instead of a bounce, you bet on a breakthrough. Our stock has been stuck below the $100 resistance. Each push to $100 comes with more strength and volume. You might expect it's about to break out. Place a buy stop that triggers above resistance, for example, $100.50. This way you only enter if the breakout is happening. Once in, old resistance at $100 becomes new support. Place a stop loss just below it, maybe $99. That protects you from false breakouts. Breakout trading is momentum-based and can produce fast, large gains. If you're just starting out, it can feel a little overwhelming. Here are a few practical tips to keep you on track. First, less is more. Don't clutter charts with dozens of lines. That causes analysis paralysis. Focus on significant long-term levels. Use a daily chart. Use a weekly chart. Draw only at major turning points that stand out. Second, wait for confirmation. It's tempting to buy the second price touches support, but price can slice right through. Wait for it to touch the level, wait for it to bounce, wait for a sign it's heading back up. You may miss a few pips, but you'll avoid countless failed trades. Patience pays. Third, always use a stop loss. Trading without a stop is like driving with no brakes. Use support and resistance to place logical stops. If you buy at support, place the stop just below it. Finally, practice on a demo account first. Many platforms offer a paper trading account or a demo account with virtual money. So there you have it, a complete breakdown of support and resistance from A to Z. We've gone from the basic definitions of these market floors and ceilings to the psychological reasons they work. We've walked through how to identify them on a chart by connecting the dots between major price turns. We've explored what happens when price tests these zones, bouncing off, breaking through. These aren't abstract theories, they are the building blocks of a structured, logical market approach. They turn chaotic price action into a readable map of opportunities. Remember, support and resistance provide context and help manage risk. Where should I get in? Where should I take profit? Where should I get out if I'm wrong? Use these levels to plan your trades and move away from emotional gambling towards strategic, business-like decisions. Go ahead, open a chart, draw some lines, start seeing the market in a whole new, much clearer way. Thank you so much for reading. I'll see you in the next one.